Dear students, today in Accountancy for class 12th, under the chapter Accounting Ratios, we are going to discuss solvency ratios. Solvency ratio expresses the relationship between long-term debts and shareholders' funds. It indicates the proportion of funds which are acquired by long-term borrowings in comparison to shareholders' funds. This ratio is calculated to ascertain the soundness of the long-term financial policies of the firm. If one has to find out the long-term financial soundness of the business, he will have to calculate the solvency ratios. Under the solvency ratios, the various ratios to be calculated are debt to equity ratio, total assets to debt ratio, proprietary ratio, and interest coverage ratio. These are the four main ratios to be calculated under the solvency ratios, and we have to go through the practical problems for these ratios. Here it is, practical problem 1. In this practical problem, we have to calculate debt equity ratio, total assets to debt ratio, and proprietary ratio. In the information, we are having equity share capital, preference share capital, general reserve, profit and loss account balance, 12% mortgage loan, current liabilities, non-current assets, and current assets at their respective values. On the basis of this information, we have to calculate debt equity ratio, total assets to debt ratio, and proprietary ratio.
Dear students, under the solvency ratios, we are going to calculate different types of solvency ratios or long-term ratios. These includes the calculation of debt equity ratio, calculation of proprietary ratio, total assets to debt ratio, and interest coverage ratio. So first of all, the question that we had taken, I had just written a summary of that question. We are having equity share capital, preference share capital, general reserve, profit and loss account balance, 12% mortgage loan, current liabilities, non-current assets, and current assets. On the basis of this information, we have to calculate debt equity ratio, total assets to debt ratio, and proprietary ratio. First of all, we will calculate debt equity ratio. And for the calculation of debt equity ratio, the formula is debt upon equity. That means debt is what? Your long-term debt, and equity stands for the shareholders' funds. The formula can also be written like this: long-term debt divided by shareholders' funds. So, firstly, we have to calculate the debt. Debt, we are having only 12% mortgage loan, 1,80,000. This is the long-term loan, so 1,80,000. This is our debt. Now we have to calculate equity. Equity means shareholders' funds. Equity consists of equity share capital, preference share capital, general reserve, profit and loss account balance, and that's it. This is what the information that is given. So equity share capital is rupees 3 lakh plus preference share capital rupees 1 lakh plus general reserve rupees 60,000 plus profit and loss account balance rupees 40,000. This is the information that is given regarding the shareholders' funds. So this will become 3, 4, 5 lakh. Now we are having both aspects: debt rupees 1,80,000 and equity rupees 5 lakh. Now on the basis of this information, we are going to calculate the debt equity ratio. Therefore, debt equity ratio is equal to, debt is rupees 1,80,000, whereas equity is rupees 5 lakh. So 1,80,000 is to be divided by 5 lakh. So we will get 0, 4 zeros are there. 50, 80, 80, 180. It's 0.53. 3s are 150, 336. 0.36. 1. So this will be written like this: 0.36 ratio 1. This is your answer. Debt equity ratio 0.36 ratio 1. This ratio indicates what proportion of funds are provided by long-term debt in comparison to shareholders' funds. General ratio should not be more than 2:1. In this case, the ratio is 0.36 ratio 1. In this case, long-term debts are only 0.36 in comparison to shareholders' funds, indicating financial soundness of the business or the company. It indicates that the business is financially sound. Now, second ratio to be calculated is total assets to debt ratio. Total assets to debt ratio. For the calculation of total assets to debt ratio, the formula is total assets divided by debt. Debt again here stands for the long-term debt. First of all, we have to calculate the total assets. Total assets, we are having share capital, preference share, general reserve, profit and loss balance, loan, current liabilities. This is non-current assets rupees 4,50,000 and current assets rupees 3,50,000. Non-current assets 4,50,000. Current assets are 3,50,000. So this will be 8 lakh. Now we got total assets rupee 8 lakh and debt we already had calculated. This is 1,80,000, or this is what the total 12% mortgage loan that is given, 1,80,000. Now we will calculate the ratio. Total assets 8 lakh divided by debt 1,80,000. 40, 18. 18 4s are 72. 8. 0.080. 4s are 4s are 4. This will go like that, divided by 1. So the ratio will be 4.44 ratio 1. This is the answer for total assets to debt ratio 4.44 ratio 1. Higher ratio indicates less use of borrowing, meaning thereby high security to lenders. So here the lenders are quite secure in this case. Now after the calculation of total assets to debt ratio, we have to move towards the proprietary ratio. For the calculation of proprietary ratio, the formula is, firstly, we will calculate here, third, proprietary ratio. For the calculation of proprietary ratio, the formula is equity or shareholders funds divided by total assets. So equity or shareholders divided by total assets. Equity we already had calculated. This is rupees 5 lakh in the first part. And total assets we had also calculated. This is rupees 8 lakh. Therefore, proprietary ratio is equal to equity. Equity is 5 lakh divided by total assets. Total assets are, these are 8 lakh. So 5 lakh divided by 8 lakh. Divided by 8. This will become 50, so 0. So 5. So 1. This will become 0.62 ratio 1. This is the answer. 0.62 ratio 1. You can also round it up. 0.63 ratio 1. If you wish to, so you can also write 0.63 ratio 1. Now this ratio can also be expressed in percentage. If we will have to express this ratio in percentage, simply we will have to multiply the formula with 100. So if we are going to multiply this 0.625 ratio this into 100, so this will become 62.5%. Either you can express this ratio in pure ratio 0.63 ratio 1 or 0.60 ratio 1, or you can express this ratio in percentage by multiplying the equity divided by total assets into 100. By multiplying the net ratio with the 100, we will get 62.5%. This is the ratio. Now 62.5% of the total assets of the company are funded by equity, indicating the long-term financial position of the company is very sound. These are your ratios that we had calculated on the basis of information which is given. So from this given information we had calculated 3 ratios. Now we are going to calculate the interest coverage ratio.
Now, in practical problem 2, we have to calculate interest coverage ratio from the information given. In the given information, we are having net profit after interest on tax, rate of income tax, 15% debentures and 12% mortgage loan. This is the information that is given. On the basis of this information, we are going to calculate now interest coverage ratio.
Now interest coverage ratio. For the calculation of interest coverage ratio, we had taken a question. Net profit after interest on tax rupees 1,20,000. Tax rate is 50%. 15% debentures rupee 1 lakh and 12% mortgage loan is rupees 1 lakh. On the basis of this given information, you have to calculate interest coverage ratio. For the calculation of interest coverage ratio, the formula is net profit before interest on tax divided by fixed interest charges. Here we are given net profit after interest and tax, and we have to calculate net profit before interest and tax. So if we add interest and tax back to the net profit after interest and tax, then we will get net profit before interest and tax. So firstly we have to calculate net profit before interest and tax. So firstly, net profit before tax. We have to calculate net profit before tax. Here the tax rate is given 50%. So after the payment of tax at the rate of 50%, we arrived at the figure 1,20,000. This is net profit after tax. So net profit after tax is 1,20,000. And if we calculate tax by taking the reciprocal of the rate, net profit after tax is 1,20,000 and reciprocal of the rate 50%, we will get 2,40,000. That means net profit before tax is rupees 2,40,000. Because the tax rate is 50%, if we deduct 50% of it, we will get 1,20,000 again. Now after this we have to add interest to this. Interest is equal to interest we have to calculate on the long term borrowings. 15% debentures. 1 lakh worth debentures are there. 15% plus 1 lakh worth mortgage loan is there. On it we have to pay 12% interest. This will be 15,000 plus 12,000. 27,000. This is the total interest. Now net profit before interest and tax is equal to net profit before tax is 2,40,000 plus interest is 27,000. This will become 2,67,000. Net profit before interest and tax rupees 2,67,000. Now interest we already had calculated, this is 27,000. So both aspects are there, net profit before interest and tax and fixed interest charges. Therefore interest coverage ratio is equal to net profit before interest and tax 2,67,000 divided by fixed interest charges 27,000. Now 2,67,000 is to be divided with 27,000. We will get after the calculation 9.888 ratio 1. It will go on like this. So we can write this like that, 9.89 ratio 1. The interest coverage ratio is 9.89 ratio 1, near about 10 times. So 10 times. Now an interest coverage of 6 to 7 times is considered appropriate. In this case, actual interest coverage ratio of the company is nearly 10 times. It means company is able to pay its interest liability regularly. This is the interest coverage ratio. In this case, the company is very much in very much sound position because it can pay its interest liabilities approximately 10 times. This is your interest coverage ratio.
That's all with solvency ratios. In the next video, we are going to discuss various activity ratios, also known as turnover ratios. Till then, thank you.
Thank you.